indexes come back. I like to joke that some of them go on to achieve great failure, but some of them actually come back very nicely. If you have two stocks, one doubles and the other falls in half, that two stock portfolio is up 25%. And that dovetails nicely with the historic record that deletions tend to beat the indexes that they came out of by 28% over the 5 years after they're kicked out.
Part of this, of course, also is the election effect as well. You've noted that history shows the stock market often rebounds before voters head to the polls, before Election Day, because there's going to be a removal of uncertainty. And of course, your data also shows that markets tend to rally after the Election Day outcome, too. Usually, when you have a big event risk, the dynamic is buy on rumors, sell on news, on something anticipated. Yet in tightly contested elections, it's buy on rumor, also buy on news. How do you explain that?
Actually, it's very straightforward. This is a bet that I've made personally many times in the last 30 years, and not just in the U.S., in Taiwan and a host of other countries. When there's a contested election, what you find is that both sides are terrified that the other side's going to win. Once the election happens, so both sides, some are terrified enough to go risk off, to take money out of the market. And when the election happens, one side breathes a sigh of relief and says, okay, I'm going back into the market. And it doesn't happen overnight. So some of it happens immediately. Some of it happens after a while. Some of it happens in the days approaching the election. So as the election approached, it looked like Trump might very well eke out a win, and the odds were starting to shift in his favor. Markets were starting to move a little bit. They exploded to the upside when he won. And it was not because of him winning. It was because his side and the other side were both risk off, and his side was happy to go risk on again. So we see this again and again. If it's a split election, where Republicans win the presidency and Dems retain one of the houses, or vice versa. The outcome's the same. There's generally about a 4% rise from a week before the election to 5 or 6 weeks after. If it is, and it doesn't matter who wins, if it's a trifecta, on average, it's about an 8% rise. If it's a Republican trifecta. If it's a Democratic trifecta, it's still a 2% rise. So the market rises regardless who wins. And the reason for that is that both sides are scared and risk off leading into the election.
So I'm looking at all the performance since the election, and everything's up a lot, including the Qs, SPY, small caps, value. I mean, you can't go wrong. If you didn't make money, you have a problem.
You had to try.
Yeah, but let's talk about value and small caps. I've seen this movie before. They have this nice little month or week, and then it's just they get rolled over by the Qs. Do you think Trump as president and his policies can make a regime change where small caps and value can actually lead the way?
I think they can lead the way, and not because of Trump winning, but because they are so deeply depressed already. I love asymmetries in risk. The macroeconomy, the narrative is everything's fine, no reason that it won't stay fine. Well, a solid growing economy can surprise to the upside and become a booming economy, or to the downside and have a slowdown, which is more likely. I think slowdown objectively is more likely than accelerating from already robust growth. Inflation, break-even inflation, expectations over the next 10 years baked into the bond market pricing, 2.3%. That should mean that 3.3 or 1.3 are equally likely. You ask 100 people, which is more likely, 3.3 or 1.3, 95 of them will say 3.3. So there's an asymmetry in that risk. Each of these works to the benefit of value and to the benefit of small cap. And small cap and value are trading cheap, historically cheap, relative to growth and large cap. So you have a relative valuation bias to the upside. You have an economic bias to the downside, which is good for small value, and you have an inflation risk bias to the upside, which is good for small value. So I look on small value as the one place in the U.S. stock market that's cheap enough to be a bargain.
Well, Rob, somehow we only have a minute left with you, but I want to talk about that risk of higher rates because I take a look at NIXT, for example, NIXT. Your average weighted market cap is about $6 billion, so pretty small there. And, you have some people saying that with Trump's policies, they could prove to be inflationary. Maybe the Fed is on hold here, or maybe they could even hike rates. And a lot of these companies have been struggling under higher rates when you think about their debt loads. How big of a risk is that to NIXT?
It's a risk to NIXT, but relative to the market, it's a benefit to NIXT. Here's how that plays out. If you have renewed inflation, the discount rate goes up. That discount rate means that the spread in valuation between growth and value narrows so that value wins relative to growth. You also have increased uncertainty, and increased uncertainty means people want to move risk off. If people want to move risk off, they're going to take money out of their most volatile parts of the market. That's the frothy growth. So what we find is upside inflation surprise is good for value. Not necessarily small cap value, but good for value. This is small cap and value. I think on a 10-year look-ahead basis, our outlook for the next 10 years for the S&P is 3% a year. Our outlook for small cap value is north of 10% a year.
All right, Rob, great place to leave it. Great to see you in person again, of course, talking about NIXT, which is up almost 11% since its mid-September launch. That is Rob Arnott of Research Affiliates. Now, coming up, BlackRock leans into stocks after the election as the world's biggest asset manager puts big money